Hello all. History has a rhythm. It's a rhythm of boom and bust, of financial euphoria followed by crushing crisis. We see it time and again. Markets soar, fueled by optimism and speculation. Fortunes are made overnight. But these periods of exuberance often mask underlying vulnerabilities. Debt levels rise, asset bubbles inflate, warnings are ignored. Then, inevitably, the music stops, the crash comes. Panic sets in. Fortunes vanish as quickly as they were made. These crises can be devastating. They can wipe out savings, cripple economies, and lead to widespread social unrest. Understanding the warning signs is crucial. By studying the echoes of past crises, we can hope to mitigate the severity of future ones. The key is to learn from history. We must recognize the patterns of boom and bust. Only then can we hope to break the cycle. The temptation to believe this time is different is always strong, but history shows us that it rarely is. The same mistakes are made again and again. Excessive leverage, unregulated markets, asset bubbles detached from reality. These are the recurring themes of financial crises. The allure of easy money is a powerful drug. It can cloud judgment and fuel irrational exuberance. This euphoria often precedes financial crises. Consider Tulip Mania in 17th century Holland. Tulips, once a rarity, became a national obsession. Prices soared to astronomical heights. People mortgaged their homes to buy tulip bulbs, betting on ever-increasing prices. It was a classic speculative bubble. Inevitably, it burst. Prices crashed, leaving thousands in financial ruin. Fast forward to the 1920s in America. The Roaring Twenties was a time of unprecedented prosperity and optimism. The stock market boomed, jazz music filled the air. People danced the Charleston and embraced a new era of consumerism. But beneath the surface, danger lurked. Debt was rising, speculation was rampant. The stock market became a casino. Then came the crash of 1929. The Great Depression followed, a stark reminder of the dangers of unbridled speculation. The stories of Tulip Mania and the Roaring Twenties hold valuable lessons. They teach us that periods of economic euphoria can be intoxicating. But they also remind us that what goes up must eventually come down. Understanding this fundamental truth is crucial to navigating the treacherous waters of financial markets. Debt, when used wisely, can be a powerful tool for growth, but excessive leverage can be a recipe for disaster. The panic of 1873 in the United States illustrates this point. Rapid railroad expansion, fueled by borrowed money, led to overbuilding and speculation. When the largest bank in the country collapsed, it triggered a chain reaction. Banks failed. Businesses went bankrupt. Unemployment soared. The crisis exposed the dangers of excessive debt and the interconnectedness of the financial system. Decades later, Japan experienced its own debt-fueled crisis. The Japanese asset price bubble of the 1980s saw real estate and stock prices reach stratospheric levels. Companies and individuals alike took on massive debts, using inflated assets as collateral. When the bubble burst, Japan was left with a mountain of bad debt and a stagnant economy. The lost decade that followed serves as a stark reminder of the long-term consequences of excessive leverage. These examples highlight a crucial point. Debt can create the illusion of prosperity. It allows individuals and businesses to live beyond their means, at least for a while. But when the music stops, as it inevitably does, the consequences can be severe. Managing debt levels is essential for long-term economic stability. Financial innovation and its discontents. Financial innovation can be a double-edged sword. On the one hand, it can lead to greater efficiency and economic growth. On the other hand, it can create new opportunities for excessive risk-taking and speculation. The South Sea Bubble of 1720 is a prime example. The South Sea Company, a British joint stock company, was granted a monopoly on trade with South America. Fueled by speculation and rumours of vast riches, the company's stock price soared. Investors, blinded by greed, failed to see the company's lack of real assets or profits. Centuries later, the world witnessed a similar story unfold during the 2008 financial crisis. Complex financial instruments such as collateralized debt obligations or CDOs were marketed as low-risk investments. In reality, they were ticking time bombs packed with subprime mortgages. When the US housing bubble burst, these complex securities became toxic assets, leading to a global financial meltdown. Financial innovation, while often beneficial, can also create new avenues for recklessness. When complex financial products are poorly understood or inadequately regulated, they can pose significant risks to the system as a whole. Transparency and oversight are crucial to mitigating these risks. Section 5. Deregulation and the perils of blind faith. Free markets are undoubtedly engines of prosperity, but history teaches us that markets need rules and regulations to function properly. Deregulation, when taken too far, can create an environment ripe for crisis. The savings and loan crisis of the 1980s in the United States is a case in point. Deregulation allowed savings and loans, or S&Ls, to engage in riskier lending practices. Many S&Ls, enticed by the promise of high returns, made bad loans that ultimately led to their collapse. The Asian financial crisis of 1997 to 98 provides another cautionary tale. Rapid deregulation and capital inflows led to a surge in risky lending and investment in Southeast Asian economies. When investor confidence waned, currencies plummeted and economies contracted. The crisis highlighted the dangers of rapid deregulation without adequate risk management and oversight. Deregulation can be a powerful tool for promoting economic growth, but it must be implemented judiciously and with appropriate safeguards in place. Blind faith in the ability of markets to self-regulate can have disastrous consequences. Striking the right balance between regulation and market freedom is an ongoing challenge. Thanks for joining me on this historical journey. If you enjoyed this trip back in time, don't forget to like, share and subscribe for more fascinating history bites. Until next time, keep exploring.